Have you ever sent in a tax payment to the IRS and thought to yourself, this is way too much. I didn't do that well last year, did I? Most of the doctors that I talk with are fine paying their fair share, but nobody wants to pay 5 figures more than they really have to. Over the next few minutes, I'm going to show you the 4 spots where medical professionals typically overpay in taxes and the strategies that will help you keep that cash in your own pocket instead of sending it away to the government. I'm Jeff Greene, CPA and founder of MedTax. I work exclusively with doctors and practice owners, so the conversation we're about to have comes from experience. Let's look at the numbers together. Let's start with structure. If you file as a sole proprietor or as a regular LLC, every dollar of profit is hit with the 15.3% self-employment tax before it even meets income taxes. On a $400,000 profit, that's roughly $61,000 in total tax, and about $17,000 of it can disappear simply because of the entity that you pick. By electing S-Corp status, you split your earnings into 2 buckets. You have a salary, which the IRS would call reasonable, and a distribution. On the salary side, that's the only side that carries payroll tax. So if your reasonable salary is $200,000 and the other $200,000 comes out as a distribution, that second half skips the self-employment layer altogether. Same clinical work, different tax treatment. Now, there's 2 quick guardrails here. You do need to run payroll, and you have to document why that salary is reasonable. Easy boxes to check once you know the rules. If you want to see your own numbers, there's a free S-Corp calculator in the link below. Plug in your net income, and in about 30 seconds, you'll know if an election is worth the paperwork. Okay, let's talk retirement plans. Your first stop is the 401k. For 2025, you can defer up to $23,500 of salary, and with a practice-sponsored profit share, the total limit jumps to $70,000. At a 37% tax bracket, that single move can chop about $25,000 off this year's tax bill. Doctors with a strong cash flow can press it even further. A cash balance plan, basically a physician-owned pension, lets a mid-career doctor drop in about another $150,000. Every dollar is deductible, cutting today's tax by roughly $55,000. Stack the 2 together, and you're shielding more than $200,000 a year from immediate taxation and keeping north of $80,000 in your own future instead of the IRS's. 2 guardrails for this one. You'll need an actuary to draft the plan and a 5-year commitment to fund it. But if you're already saving aggressively, this is hands down the most efficient way to turn income into long-term wealth. In S-Corp, the IRS expects you to pay yourself a salary that makes sense for your specialty. If you pick a number out of thin air, you're either going to be overpaying in payroll taxes or you're going to be waving a red flag at IRS auditors. We start with real compensation surveys. Cardiology in the Midwest looks different from Boston pediatrics. Then we land on a salary that would pass the shrug test with any IRS agent. Here's what that means in terms of dollars. Again, say your practice nets $400,000 for the year, and the data shows that $180,000 is a fair wage for your role. You pay tax on that $180,000, you take the other $220,000 as a distribution, and you skip the 15.3% payroll tax layer on that distribution chunk. The result is roughly $8,000 to $12,000 back in your pocket every year, with documentation to keep the IRS comfortable. Here's an often missed opportunity: paying your kids, or even a spouse, for real work in the practice. A 16-year-old who scans charts or updates your Instagram can earn up to $14,600 in 2025 before a single dollar of federal tax kicks in. Your practice deducts the wage at your top bracket, say 37%. So every $10,000 you shift to them trims about $3,700 from your tax bill. 2 quick rules of the road here. The job must be legit. Keep timesheets, task lists, a simple employment agreement, exactly what you'd expect from any staff file, and pay what you'd pay a non-family hire. $10 an hour for clerical work passes muster. $100 an hour does not. Do it through a sole proprietor subsidiary, and for children under 18, even Social Security and Medicare taxes disappear. Here's a bonus tip: funnel part of their paycheck into a Roth IRA. It's tax-free now, and it's tax-free forever. Plus, they can use the Roth funds for qualified education expenses when they go off to college. Real help for you, early retirement jumpstart for them, and fewer dollars headed to the IRS. All 4 strategies that we've spoken about today share one key theme: they only work with year-round planning, not just linking up with your accountant in April. At MedTax, year-round proactive strategy is our day job. so you can focus on your practice instead of the tax code. If these ideas hit home, head to the link in the description below and book a free discovery call today. We'll look at your numbers, identify tax saving opportunities, and map out the next steps. No pressure, just clarity. See you in the next one.